Hi guys, welcome back to the channel. My name is Rebecca and on this channel I go for all things accounting, finance and investment related, so if you like this kind of stuff then please do consider subscribing, and otherwise let's get straight into the video. So in today's video we're going to cover mortgage interest rates, and we're going to keep this particular to the UK, so the United Kingdom. So when you go for a mortgage for the first time, there's two different elements to that mortgage. There's the capital element and the interest element. So the capital amount is just the money that you borrow, whereas the interest is the interest rate that they're going to charge you over the course of the mortgage. Now we can simplify interest rates by putting them into two categories. So we've got fixed interest rates and variable interest rates. Now fixed interest rates don't change over the course of that mortgage. So you might have a fixed interest rate for 2 to 5 years or maybe even longer. But what it means is that the amount of interest that you're paying every month is not going to alter. So it's not going to go up and down, it's going to stay exactly the same for that length of time per the agreement. Whereas a variable interest rate fluctuates up and down in line with the Bank of England base rate. Now the most common form of a mortgage in the UK is what we call a capital and repayment mortgage. So throughout the course of the mortgage you're going to be paying back both the capital that you owe and also the interest. So it's not like other mortgages like a buy-to-let where you're going to have an interest-only mortgage where you're only paying off the interest. With a capital repayment mortgage, you're paying both the capital and the interest. So with this type of mortgage, the amount that you're paying back over the course of the mortgage, so whether that be 10 years, 20 years, 25 years, you're going to start to see that the amount that you pay each month slowly goes down, because the amount that you owe at that particular snapshot in time is less than what you owed right at the beginning of the mortgage. So an interest-only mortgage is a mortgage that you take out where you're only paying towards the interest cost of that mortgage. So what it means is that you're not making any capital repayments at all. So these tend to be a lot cheaper for individuals because you are just paying that interest element, and you see that a lot in buy-to-let mortgages. But what it means is that by the end of the mortgage you then have the capital amount to repay. So what about standard variable rate, otherwise known as SVR? This is just the interest rate that a mortgage provider applies to their mortgage, and it roughly follows the Bank of England base rate, but it sometimes can fluctuate. Now if you're on one of these SVR interest rate mortgages, then you tend to stay on that particular percentage of interest throughout the length of the mortgage. But it means that the amount of interest that you're paying each month, so the total payments that you actually pay, which includes your capital and your interest, is going to fluctuate month on month because it's linked to the Bank of England base rate. Now if you're looking at your mortgage and you're looking at the fine print, sometimes if you've got one of these SVR style mortgages, you might have a discount rate. This is where they'll apply a very small discount to the lender's standard variable rate, and that won't be for the entire length of the mortgage. It might just be an introductory offer for say the first couple of years, but it does just depend on the mortgage provider. Now one thing I'll say about these SVR interest rates, and particularly the discounted interest rate, is that just because they're giving you a bigger discount rate doesn't mean that overall the mortgage is going to cost you less. So it's definitely worth looking at the fine print and seeing what the initial SVR is. So for instance, where a lender has given you an SVR of 7% and a discount of 3%, that means that you're going to be paying 4%. But if the SVR is only 5% and they're giving you a discount rate of 2%, that means overall you're only going to be paying 3%. So it's definitely worth looking at the small print. Now the pros of one of these types of mortgages is that initially the cost of the mortgage is quite low in comparable to other mortgages that you might be eligible for. But a con to this is, again, because they're linked to the Bank of England base rate, if that fluctuates, then the amount of interest that you pay on your mortgage is also going to fluctuate. Tracker rates. Now tracker rates move in line directly with other interest rates, and normally this is the Bank of England base rate. So if the Bank of England base rate goes up, so does the cost of the mortgage. Now these tracker rates tend to have a very small lifetime, so they're usually only between 2 and 5 years. But there are some tracker rate mortgages that do last the entire length of the mortgage, or until you switch to another deal. Maximum loan to value. Now the loan to value is just the amount that you want to borrow against a property. For instance, if a property's market value is £100,000 and you want to borrow £60,000, then that means your loan to value is 60%. Now if you're taking a look at a buy-to-let mortgage, this differs again to different types of mortgages that you're going to get on a property where you're going to live in it. So there's different criteria that you've got to meet with a buy-to-let mortgage, and the interest rates that they offer are also very different to other mortgage interest rates. Now buy-to-let mortgages work a little bit different to normal mortgages because the amount that you can borrow is linked directly to the amount of rental income that you can achieve from that particular property, and also the interest rates that are available differ slightly. So you can get, again, tracker interest rate mortgages, you can get interest only mortgages, and you can also get capital and interest repayment mortgages, but it all depends on what interest rates the provider is offering on those mortgages. APRC, the annual percentage rate of charge, is just a percentage of the total amount of credit that you've taken out. So this is expressed as an annual percentage. AVM. Now AVM just stands for Automated Valuation Model. So instead of a mortgage provider going out and surveying your property, they can do a quick search to find out how much a property might be worth. Base rate. Now this is just the UK's core interest rate that's set by the Bank of England, and the standard variable rate that we mentioned earlier is always slightly higher than this Bank of England base rate. Capped rate. So a capped interest rate mortgage is just an amount that allows your interest rate to climb to only a certain amount before it's capped, and it won't go any higher than that. They don't tend to last for the entire length of a mortgage usually. Cashback. Now sometimes, depending again on the mortgage and the provider and what type of mortgage you're looking at, you might be able to get cashback on the mortgage as an introductory offer to taking out the mortgage with that particular provider. Completion. Now completion is just the final stage of the house purchasing process, and that only comes after the exchange of contracts between the seller and the buyer. Now the completion only occurs when the property's agreed sales price, less any deposit that have been paid, reaches the seller's bank account. Conveyancing. Now conveyancing is just usually carried out by a solicitor or a licensed conveyancer, and this includes proving the property is really owned by the seller, making sure that all loans attached to that particular property are discharged. And it also usually involves a local search for planning permission, upcoming developments, etc., which might just affect the value of that property that you're looking at buying. Deeds. Deeds of a property are just a formal written document that show who owns that property, and there is a title deed register that you can go on to find out who actually owns any property within the UK, and I think it costs about £3 to run your own title deeds check. Now deposit percentage change depending again on the type of mortgage that you want to take out. So if you want to look at a buy-to-let mortgage, you could be looking at as much as 30% deposit on the property that you want to purchase, whereas other types of mortgages like the common capital and interest paid mortgage, they tend to be anywhere between 5 and 10%, and that's on the total value of that property, so the market value of that property. ERC. So ERCs just stand for early repayment charge, so there might be a clause in the mortgage that you've taken out to say that you can't actually pay over a set amount, over and above the normal monthly payments towards that mortgage. So sometimes you can get mortgages that allow you to pay up to 10% on top of the monthly repayments that you're already making, and other times you might be charged this early repayment fee if you do make those payments. Stamp duty land tax is a tax that you have to pay to HMRC on the purchase of a property, but there's certain criteria that might mean that you pay a lower amount of stamp duty land tax or more, depending on, for instance, if it's a second home that you're purchasing. But it's definitely worth consulting a professional or doing your own research around stamp duty land tax and how much you might have to pay. So I hope you found all of that useful. Please do consider subscribing as always, and I shall see you on the next video.